We've got a former Fed insider joining us right now, asking what he says about the rise in Treasury yields. Al Broaddus spent 40 years at the central bank, including more than a decade as president of the Richmond Fed. Al, a pleasure to have you on. Thanks for joining us. Let me ask you what you make of Treasury yields here. I mean, yesterday we talked to Jeremy Siegel. He thinks it's a sign that Fed QE is working, but clearly holding interest rates down is not what they're doing.
Well, I think that a good bit of this rise, as was just suggested, Matt, is an increase in real rates. I think that to a considerable extent reflects the stronger economic data we've been seeing. As you well know, people have been raising their forecast for 2011. The overall economic outlook, at least for the medium term, looks stronger. So the natural thing that happens then is that real rates begin to move up. They don't move up smoothly. So, there'll be a big jump and then maybe some correction. But I think that's a good bit of it. I think an important point was just made, though. It doesn't appear that a lot of this is an increase in the inflation premium. And the measure that was just mentioned of inflation expectations suggests that has not moved a lot. So that, as of yet, is not a major part of the problem, although obviously, that's a longer run risk with anything like QE, too, the possibility that the inflation outlook will change. So that the Fed's going to have to watch that carefully. But for right now, I think we're okay.
Al, an earlier guest, John Brynjolfsson, he made the point. He says deflation's off the table for next year. He said also a double dip is off the table for next year. You agree?
I think so. And indeed, I would argue, a lot of how one evaluates whether QE2 has been working or not, Carol, depends on what you think his subjective was. And, of course, different people at the Fed have their own views, obviously. My own feeling has always been that the main value of it was to keep us from drifting into deflation. Not that I think that risk was ever great, but the problem is if you ever get into that, very difficult to get out of it. It would appear that the program has worked pretty well. Actual inflation is still very low, but rather than continuing to drift down, measures of inflation expectations have stabilized and actually begun to move up modestly, which in some sense is a good outcome.
Well, Matt,
I think. Yeah. Go ahead.
No, you please finish.
Well, I was just going to say I think the risk of a double dip now is significantly reduced, very small, I would say. I think the recovery will continue. And I also think the risk of drifting into deflation, while never very great, it's even less now. I think that's almost off the table, and that's a good thing.
Al, Matt mentioned Jeremy Siegel, who we talked to yesterday, who's very upbeat on the economy. He even said that we could start to see the Fed change its rate policy, start to raise rates much sooner than everybody expects, maybe by the middle of next year. Do you buy into that as well?
Well, it's always a guess, Carol. I guess my instinct is it will not come that quickly. Despite this better news on the economy, pretty clear there's still a lot of excess capacity out there. I think the one less optimistic statistic we've gotten recently has been the job report from November. That was a good reminder that the economy still has a lot of slack. So my guess is it's going to take a little bit longer than Jeremy is expecting for the Fed to turn around, but you can't rule it out. And I think the key thing is for the Fed to be very vigilant in watching developments and move as soon as it needs to. And that usually means a little bit sooner maybe than the political establishment and others may think is wise.
So, Al, when you look out at 2011, what do you think are going to be the key stories when it comes to the economy, to the Fed? Do we start to really kind of move forward at that point, or is it more of the same, meaning more of what we saw in 2010?
Well, it's always a bit of a guess, Carol, but my own view is that there are a lot of signs now that this recovery is beginning to gain a little more momentum than we might have expected just a few months ago. And I think, I think earlier when I was interviewed a while back by you folks, I said, the economy is in some sense like an organism. It's healing. That's what this process is all about, and it's proceeding. My sense is that process, we're underlying all of this about policy, is the fact that process is maybe gaining more momentum and proceeding more rapidly than had been anticipated. So my expectation is you may see more of that as the year unfolds. That will put the Fed in a position of having to say, hey, how fast is this thing going to move? Try to make some judgment about when deflation will completely fade into the background, and they will need to focus on turning things around to make sure that we don't get a pump in on the inflation.
Do you think, Al, that the Fed at some point then pulls back, or does the Fed have to pull back with the Republican Congress coming in, putting more political pressure on it?
Well, I think there's an awful lot of politics surrounding monetary policy now, which personally, Matt, I think is unfortunate. But I think what the Fed needs to do is to try to put that aside, do what it always does well and what it's capable of doing, and that is analyzing the economy as effectively as anyone can, trying to get as good a read on where it's headed, what the risks are, and then taking policy actions that address that.
Let me ask you about the transparency at the Fed, which is kind of a new thing that Ben Bernanke has brought in here. Do you think it makes Fed policy less effective to always show their cards? I mean, wouldn't a little bit of secrecy, a little bit of a jump on the market kind of help move things around in a quicker fashion?
Well, that's an issue that I've had to deal with throughout my career, Matt. We've come a long way. Just to put it quickly in perspective, there was almost total secrecy when I joined the Fed. We've moved very far in the direction of greater transparency, and I think that's all to the good for a central bank in a democratic society. At the same time, yeah, it does create some short-run issues. There can be misunderstandings. You can have different people at the Fed saying different things, and that can cause some problems. But by and large, I think the move towards greater transparency and openness is good for the Fed, good for the country, and I do hope it will continue.
Well, but the market expects $600 billion in Treasury purchases, and if you disappoint the market, it won't be good.
Well, I think to a large extent that comes down to communication. If you read the statement that was released, this doesn't get a lot of attention, but there's a key paragraph that says that's our intention, but if conditions change, we may modify that. It doesn't use exactly those words, but that's the message. And I think as long as the Fed continues to remind markets and the public of this, and then if, in fact, they have to cut it, maybe the economy really begins to show more steam than we expect, and it becomes apparent that maybe they can reduce the size of that program, let people know as soon as you have that sense and give a good explanation as to why. I think the Fed can do that. I don't think it will lose any credibility. I think it'll gain credibility.
All right, Al, we're going to leave it on that note. Al, thank you so much. Al Broaddus joining us. Al, have a great holiday. Thank you.
And you too.